In this session, we will look at primary market for equity stocks and the secondary markets for equity stocks, how equity stocks are traded in the secondary market. Primary markets is what we will look at first. Firms go to primary markets to raise equity capital by issuing fresh equity stocks. The first round of issuing equity stocks by any firm, when, for instance, a privately held firm goes public, enabling its equity stocks to be traded, is referred to as the initial public offer or IPO, and all subsequent rounds of issuing equity stocks are referred to as follow-on public offer or FPO. Transactions involving issue of fresh equity stocks, i.e. IPO, are generally managed by investment banks and such other entities who play the role of an intermediary between the firms issuing the equity stocks and the prospective investors. Quite often, for an additional fee, these intermediaries also underwrite the offer, i.e. the intermediary will subscribe fully to the equity stocks that remain unsubscribed after the offers closed for public subscription. Through this process, therefore, the risk of undersubscription is transferred to the intermediary who is the underwriter, who in turn could potentially become the market maker for that equity stock going forward. When the issue size is very large, multiple intermediaries, referred to as a syndicate, combine to help sell and distribute the new equity stock issue. Now let's look at secondary markets. Secondary market is where the equity stocks once issued by a firm through an IPO or an FPO are traded, i.e. bought and sold by investors in the equity stock markets with an eye on making profits. Such trading is carried out in the stock exchanges where that equity stock is listed. Examples of stock exchanges around the world include the London Stock Exchange, the New York Stock Exchange, the Tokyo Stock Exchange, etc. A list of the top 10 stock exchanges by the total market capitalization of equity stocks traded in that exchange can be found in a document link available at the end of this video. Now let's look at the trading mechanisms, i.e. how are equity stocks bought and sold. Trading in equity stocks is carried out in stock exchanges in a very orderly manner through a hierarchy comprising the exchange, the brokers registered with that exchange, and the investors who buy and sell through those brokers. For several decades, the trading in equity stocks was carried out in physical form in the trading floor of the exchange, with the brokers or their authorized representatives being physically present in the trading floor to execute the trades during the trading hours and later as part of the settlement cycle to transfer the equity stocks in physical form and register them in the name of the buyer. With the rapid advances in information technology, trading in equity stocks as well as the settlement process, which is the transfer of equity stocks for cash between buyers and sellers, has been completely automated and made fully electronic. The block diagram that follows will explain this process in its simplest form. Investor A submits a request electronically to his broker A to buy, say, 100 shares of firm X. Broker A submits this request, i.e. the buy order as it is known, electronically to the exchange on behalf of investor A. This buy order will wait in the buy order queue. Around the same time, say, investor B submits a request electronically to his broker B to sell, say 100 shares of the same firm X. Broker B submits this request, called the sell order, electronically to the exchange on behalf of investor B. The buy order and the sell order will then be matched automatically and confirmation of trade sent to the broker A and to the broker B. In this example, buy order and sell order matched in quantity. It was 100 each. If, let us say, the sell order was only for 50 shares and the buy order was for 100 shares, if you recall, then only 50 of the buy order will be matched off and the remaining 50 will wait in the buy order queue until another sell order is received. Vice versa, if the sell order exceeds the buy order. Such confirmed trades are handed off electronically to the clearing entity, which is also known as the clearing house, that is affiliated to the stock exchange where the trade was executed for final settlement. In this settlement process overseen by the clearing entity, the transaction is settled electronically in the following sequence. Seller's securities account is debited to the extent of the shares sold. Buyer's bank account is debited for the value of shares purchased. Buyer's security account is credited with the shares purchased and the seller's bank account is credited for the value of the shares sold. Electronic trading in the equity stock markets has rapidly replaced all other modes of trading in the stock exchange for several reasons, including the following. Elapsed time between the date when the trade is executed on the exchange and the actual settlement is no more than 1 day. This elapsed time was much longer in the case of the earlier physical floor-based trading. 2. Electronic trading is absolutely anonymous. In other words, sellers and buyers do not know each other's identity. Number 3. Settlement of all trades is guaranteed by the stock exchange. In other words, even if either party is default, the person who is to receive the shares will receive it and the person who has sold the shares will receive the money. These attributes of anonymous trading and guaranteed settlement has significantly enhanced transparency and price discovery, and consequently, the volume traded in the equity stock markets have gone up exponentially across the world over the last decade and a half. Trades are executed on the exchange on the basis of what is referred to as market order and limit order. Let's look at what these two phrases mean. Market order is an instruction to the broker to sell or buy at the best price that is prevailing at that time. A limit order, on the other hand, is an instruction to the broker to buy or sell only at the price specified by their client, i.e. the ultimate investor. If the specified price is not reached in a limit order, the order is simply not executed. Some limit orders also carry a time limit, which means if the price is not reached within the time limit specified, it will not be executed and automatically deleted from the buy order queue or the sell order queue, as the case may be.